You gotta use them too. As we've been discussing, the Fed is predicted to raise rates 75 basis points for a fourth and maybe final time today, followed by a potentially smaller hike in December. But if the Fed slows the pace of its hikes, what does that mean for investors going into 2023? Probably more importantly, what if it doesn't? Tematica Research's Chief Investment Officer, Chris Versace, joins us now. Chris, I was just checking the latest tally. The S&P 500 up about 7.8% from its lows earlier in mid-October. Is the market setting itself up to get burned here by maybe getting too optimistic that the Fed is closer to a pause?
So, Julie, we at Tematica have a word for that. We call it opium. And we've seen the market kind of get hit a little bit, over the last several months with hopium trying to overread into what the Fed may be doing. And I think when you sit back, you look at the data, even the data we saw this morning with the ADP employment change report for October, the jobs number was better than expected. The year over year wage gains were, 7.7% or so, very little changed from what we saw in September. And then we backfill in with some of the other data that we've been getting, a stronger than expected GDP reading for the September quarter, the employment cost index still hot, core PCE price index still elevated. There's a lot of reasons to think that the Fed has enough cover to continue to raise rates where it's looking at. And the thing is, the market expectation, what's been helping drive the market higher, as you noted, is the note that, hey, maybe they will back off a little bit. So I do think there's room for the market to be disappointed.
Hopium and a prayer that the Fed will back off, Chris, here. So when we think about what that timeline actually looks like and how much the extent is that the market has misread the Fed, what does that look like in your perspective?
Well, look, clearly we're going to get, some insight as to what they're thinking about the December meeting, maybe what the pace of monetary policy could be in 2023. But I think at a minimum, Brad, whether or not, we see 50 or 75 in December, we still have to remember that the Fed funds rate is going to be significant, doesn't even, catch it. It's going to be up dramatically compared to where it was entering 2022. And I don't think we've seen the full impact of that yet or ripple through the economy. We have in housing because what we've seen in the mortgage arena. But, what does that mean for consumer borrowing as interest costs continue to grow higher? What does that mean in the automotive arena as auto loan costs get higher? So I do think there's more follow through, if you will. But I think candidly, the market might be leaning too much into, is it 50? Is it 75?
Chris, I know you follow a lot of sectors and a lot of stocks. And, are you bullish on the metaverse as a theme? And if you are, how do you play it? I mean, look, I used to edit your stuff. I know you watch everything. Talk to me. What do you think about that sector?
So the short answer to that is no. When we took over Action Alerts Plus last year, we made the strategic decision to exit then Facebook around, I think, 3:30, something like that. And candidly, we haven't looked back. So if you're looking at it as a play on meta platforms, I don't think it's there. I'm not really sure, Brian, what they're going to do to reinvigorate the revenue line as they continue to pour money into the metaverse. But to me, this is very similar to what we saw with Second Life almost a decade ago, where there was an initial spur and then it fizzled. The question that I struggle with when it comes to the metaverse is, what is the killer app? Why will people go and continue to go in mass? And how do they drive revenue? Not just Meta, but really anybody. And I don't think it's really I don't think the answer is there yet.
Just to follow on that, with the kind of present nature of the vacuum of easy money policies, does the metaverse actually become a reality?
I think look, anytime we have these new technologies, right? And I'm going to date myself here a little bit, Brad. So back in 1999, 2000, when I was a younger man, I heard all about 3G. 3G is coming. 3G is going to revolutionize everything. And it's going to be here next year. And it took several years for 3G not only to really have the networks built, the devices there, but for the applications to emerge that really drove the incremental average revenue per user the carriers were booking. So I think we're going to see that again. And will it happen? Yes. I think like autonomous cars and everything else, the timeline is just going to be a lot longer than we originally think.
3G and Second Life. You're really taking me back here, Chris. So within technology, then, what is more attractive to you? If you're looking specifically in that, does it does it pay to stay more boring, for lack of a better word, right now?
Well, it's an interesting question, and I say that because over the last several months, when in the Action Alerts Plus portfolio that we run for the street, we've actually exited a number of technology companies. When we took the portfolio over, it was overinvested in technology. Again, this was about a year ago, and we've whittled that away. And the landscape, I think, is a little murky right now, to be kind. We heard what AMD said last night. Data center looks like it's holding up better. PC continues to be worse. We're hearing repeated conversations about slowing smartphone sales. So it's hard to get excited about technology. And I know some people will come out and they'll say, well, these stocks are cheap. And my reply, as Brian will probably guess, is, when I put my analyst hat on, is, well, how are they cheap when I don't really know what the E is, or I don't know what the S is in price to sales, because those numbers are coming down. So I want to like technology because it does have a lot of, disruptive and productivity plays, but I don't think we're there yet, Julie.
Chris, what about industrials then?
So industrials are an interesting way to look at it. I used to cover that back in my early days, and it's a very wide category. So you can have everything from trucks and rails to construction equipment and ag equipment. I think those latter two are a lot more interesting. Construction equipment, Caterpillar put up some great numbers with their U.S. construction business in the September quarter. We're starting to see some of the benefits flow through for demand on the Biden infrastructure law. That's why we like United Rentals, we like Vulcan Materials as well. And that thesis was really confirmed this morning by what Martin Marietta had to say. So we like those. And then on the ag equipment side, look, farmer income is killing it. And historically, when that happens, they tend to replace their equipment. We also have, if you want to talk, a little bit of technology, this real push in precision ag. Farmers are struggling with high fertilizer costs. I think that's going to accelerate that move.
Interesting. Love to talk some precision ag. We'll do it at more length another time, Chris. Thanks so much. Chris Versace. I'm not even kidding. Tematica Research Chief Investment Officer.
Thank you.